All right, let's dive right in. Today we are decoding stock options. These are an incredibly powerful tool that lets you profit not just when a stock goes up, but also when it goes down. So if you've ever had that gut feeling, that deep conviction that a stock is about to make a big move, and you wanted a way to act on it with limited risk, well, you're in the right place. This explainer is absolutely for you.
So think about it for a second. You know that one company you're always keeping an eye on? What's your gut telling you? Do you think its stock is ready to take off, to just climb and climb? Or are you seeing some warning signs, some hints of a drop on the horizon? That feeling right there, that conviction, it doesn't matter if you're bullish or bearish. That's literally all you need to get started.
See, your prediction, it basically points you down one of two paths. It's kind of like a fork in the road. If you're an optimist, you're on team bullish, and you believe that stock is going to go up. Your path is call options. But if you're feeling pessimistic, expecting a fall, then your tool is the put option. It's that simple. Two totally different outlooks, two totally different strategies.
Okay, so let's go down that first path, the bullish bet. This is the one for all the optimists out there. The folks who see a stock's price and think, yeah, that thing's heading for the moon, and you just want to grab a ticket for the ride.
So what exactly is a call option? It gives you the right, but, and this part is absolutely crucial, not the obligation to buy a stock at a price you lock in today. We call that the strike price. Think of it like this. It's like putting a small refundable deposit down on a house to lock in today's price, just in case the neighborhood gets super popular and prices go through the roof. You have the choice to buy later, but you don't have to. And honestly, this right here, this is probably the most attractive part about buying a call. Just look at the risk. The absolute most you can ever lose is that small fee you paid for the option, that premium. That's it, period. Your risk is completely capped. But the reward? Well, what's the reward? If you're right and that stock just soars, your profit potential is, and I'm not kidding, theoretically unlimited. Okay, but what if your gut is telling you the exact opposite? What if you're looking at a stock and thinking, no way, that thing is way overvalued. It's headed for a fall. Well, now we get to flip the coin over and look at the other side. This is the strategy for the pessimist, or hey, maybe just the realist. This is the bearish bet.
A put option is, you guessed it, the perfect mirror image of a call. It gives you the right, again, not the obligation, to sell shares at that locked-in strike price. Now, why is this so powerful? Well, it becomes an incredible tool if the stock's actual market price falls below the price you have the right to sell at.
And look at this. Once again, that risk-reward setup is just fantastic for the buyer. Your maximum loss is just the premium you paid for that contract. You can't lose a penny more. But the reward? Oh, the reward comes as the stock price falls. The further it drops, the more valuable your put option becomes. Your max profit happens if the stock price, in a dramatic turn of events, goes all the way down to zero.
So, okay, we've got these two really powerful tools, right? Calls and puts. But now, I'm going to let you in on the secret to how most traders actually profit from them. And for anyone new to this idea is a total game changer. You almost never have to actually buy or sell the stock itself. No, really. So what's the secret? It's this. You make money by selling your option contract for more than you paid for it, usually long before it expires. You have to remember, the contract itself is an asset. It has a price, and that price fluctuates. The goal for most of us is just to sell that contract to someone else for a higher price. You're not trading the stock, you're trading the contract.
So you might be asking, okay, what actually makes my contract worth more? Well, it's mainly three things. First, and this one's pretty obvious, the stock's price moves in the direction you wanted it to. Second is volatility. Think of it like this. If everyone expects a hurricane, the price of storm insurance goes up, right? Same idea. When the market expects big price swings, options get more valuable. And third is time. The more time left on your contract, the more chances it has to become profitable, so it holds more value.
Theory is one thing. But let's make this really concrete. Let's actually walk through a quick example with a call option so you can see how you'd profit without ever having to buy the stock. Okay, let's say you're feeling bullish on Chipotle, ticker CMG. You decide to buy one call option contract. The price, or the premium, is $1 per share. Now, since a standard options contract represents 100 shares, your total cost is simple. $1 times 100. That's $100. And remember, that's also your maximum risk on this entire trade.
Fast forward a week, some amazing news drops about, I don't know, a new kind of burrito, and Chipotle's stock price jumps. All of a sudden, everyone wants in. Demand for your specific call option skyrockets, and its premium shoots up to $2.50 a share. So now that contract you bought for $100, it's worth $250. So what do? You decide it's time to take your winnings off the table. You sell the contract for its new higher value of $250. You subtract the $100 you originally paid, and boom, you've just made a $150 profit. And you did it all without ever needing to own a single share of that pricey Chipotle stock. See how that works? So you might wonder, why sell early? Why not wait until the very last second? Well, it all comes down to smart strategy. First, you lock in those profits before the market has a chance to change its mind and go against you. You also avoid the nightmare scenario where your option expires completely worthless. And this is a big one. You capture its remaining time value. Think of time value as a melting ice cube. It's a part of the option's price that disappears a little bit every single day. You want to sell it before it melts away completely.
All right, let's pull all of this together. It's time to summarize the most important takeaways from everything we've covered. When you boil it all down, it's really this simple. Calls are your bet when you think a stock is going up. Puts are your bet when you think a stock is going down. And for both of them, the main goal for most people is just to sell that contract for more money than you bought it for. Buy low, sell high. That's the name of the game.
And if there's one thing you remember from this, let it be this. When you buy an option, your risk is always limited to what you paid for it. You know exactly what you stand to lose before you even enter the trade. After that, your potential for profit really just comes down to one thing: how right you were about where that stock was headed.
And that really brings us to the end of our explainer. You now have the basic roadmap for both the bullish and the bearish paths in the world of options. So, the only question left for you is this. Looking at the market right now, with everything you know, which one of these paths would you want to explore first?